Good afternoon. I'm Marcel Rindisbacher. I'm the director of the Ravi K. Mehrotra Institute for Business Markets and Society. We are the institute that is responsible for this two-day program on short-termism. And this is the closing panel. And the subtitle is Solutions to Short-Termism. So it's a very simple task in an hour to basically provide all the solutions there are. But I also understand that a lot of conversations have happened over these 2 days, and I hope that we will not be too repetitive. But I thought I will structure the conversation about this really sort of a little bit after the title of the Institute. It's the Institute for Business, Markets, and Society. And I think the angles you can take to talk about short-termism is maybe a business angle, then a market angle, and then society more about regulation or things like that. So, but before I start, I would like to introduce our distinguished panelists. So we have Jane Steinmetz. She is the Boston office managing principal of Ernst & Young. So thank you for coming. We have Paul Clancy. He is the former CFO of Alexion Pharmaceuticals and Biogen, and he's on the boards of several biotech and biopharma companies here in the Boston area. We have J.B. Spence. He leads the Deloitte accounting and reporting advisory practice in New England. And last but not least, Bill Huyett. He is a very academic title, Director Emeritus, so something we know here at the university about Emeritus of McKinsey. So, okay, but before I start also, because we have also diverging opinions about what short-termism is, and so I basically would like to go around and ask each of the panelists about a kind of what do you see as short-termism, and is it really something that we should be concerned about, or is it something that is rather a kind of buzzword that at the end of the day doesn't have much content? And then, because we talk about solutions, we first should really sort of listen to you and hear if that's a problem or not. So who would like to start? Jane?
Sure. So is this working? So I would say short-termism is just a focus on immediate return. And immediate could be a week, a month, a year. It has a negative connotation, but there is a need to have some focus on short-termism, the short-term results. But when it comes to a trade-off between how you're investing and acting for short-term, you just have to balance that, because at the end of the day, a long-term view, in my opinion, is what's the most healthiest for a company.
I'll just add. I think that's all. I think it's something in the middle of what Marcel proposed. Is it a big issue? Is it not? I love how the students in their papers kind of teed up the definition of short-termism, which was a focus on the short term at the expense of the long term value. And too often, by the way, many of you are gonna go into jobs in business, and you're gonna be asked to be incredibly short-term oriented. And that's good, right? That's kind of like execution orientation and stuff like that. And I think this really comes to a head at the most senior parts of an organization, where the responsibility moves towards, making sure they lead the whole organization to be execution oriented, to deliver results, but at the same time, making sure that they put a ton of focus, and actually the biggest amount of their mind share, into how to evolve the business over a long period of time. I think it does get a little bit too easy a rap that everybody in corporate America is short-term oriented. I personally believe it's a bit of a dichotomy, in that we have some incredible examples of companies, and I would point to Amazon. I'd point to Google, what they've done, when Amanda kind of shared that with us kind of earlier today, that have done this balance incredibly well. And then there's others that get swept up into kind of the short-term nature, particularly of Wall Street, and particularly of chasing short-term EPS numbers. So I think it's a bit of a dichotomy. And one way to think about it is companies that are in attractive markets, you guys learn this in business, are in attractive markets and have really strong sources of competitive advantage, which, I sat in Lewis's class a month ago, and he talked about that drives high ROIC, return on invested capital, for those companies. they're richly rewarded by investors, as evidenced by trillion-dollar market cap companies. Whereas companies that don't have that, they're not in attractive markets, and there's plenty of them. Plenty of companies that aren't, right? They're in low margin, tough markets. They don't have a big source. Then what happens is the investment community, to some extent, appropriately, is like, are you going to fix your business? Are you going to fix your? Are you going to like? They get a little bit short. But I do think that, and then across companies, has to be very mindful of getting pulled into things that are too short-term oriented and don't focus on the long term.
Anything to add?
Yeah, I'll add one thing. I mean, I think it is important, especially the long-term view, if it comes at the expense of the short-termism. I mean, I don't think there's anything wrong with short-term goals, and they can be used as milestones for measuring progress towards long-term goals. So I think it's important to have that balance and measured approach that you both talked about before. So I see this as, you know, the ideal situation would be focused on the long term, but using short-term goals and success as to tracking as to how you're measuring on that long-term plan. And if you fall short of something, understanding what that means. Am I falling short of something in the short term because something changed and I'm getting away from that long-term plan, or because I learned something new and that's sort of a building block or stepping stone for the next piece? So that's sort of the push and pull, I think, of the short-term versus long-term model that I think is probably the best balance to have.
Yes.
There we go. It's inaccurate. On the other hand, short-termism kind of in my world has two manifestations. The first and the simple one is accounting for earnings smoothness and other accounting tricks, perfectly legal, but accounting tricks to obscure typically volatility. The second, more insidious and more value-destroying one is not funding things that create high NPV, high ROIC projects for the company. If you survey CEOs and they answer anonymously, 3/4 of them will say they will do that all the time. 25% don't. So it's not like it's 25% bad guys, 75% value maximizers. It's a pretty widespread, and we'll get into exploring why. The good news is that first, the performance of non-short-term companies is statistically significantly higher and pretty significant in magnitude than those that are run by short-term. Good news is it's also very easy to spot companies that are short-term in this day and age. And the people who think long-term are dramatic outperformers in ROIC and revenue growth, in job creation, by the way, as well as total return to shareholders. The last point I'll make is 75% of the market cap of the United States is owned by investors who have the capability to make decisions that discriminate against short-term behaviors of top management team.
Thank you so much. Now, when you think about sort of like the role of business to create value for the long term, somehow it starts at the top with sort of the board, corporate governance. So what are kind of key factors that boards should pay attention to, that in this world where you said where a lot of employees had to focus on the short term, but there's a kind of really culture where long-term thinking is sort of prevalent and people really don't lose the big picture thing? Is that something that needs sort of corporate governance structure adjustments? Because some people see short-termism as like a chronic kind of thing with shareholder capitalism and their fundamental kind of proposals about how to introduce new forms of stakeholder capitalism and things like that. So, but in some sense, there's a big question about the board level, governance level. What do you do to really make clear that people see that the long term is really the thing that creates value? So,
I'll take a crack. I think actually the solutions, in fact, rest with the board of directors, not regulators or accounting standards setting bodies. There's two mechanisms of action, to use the drug industry term. I think the first is the boards have to start paying attention to the use of capital. And there are very, very few boards. Paul mentioned the names of some companies whose boards are good at this, but virtually all company boards are not very skillful at overseeing the long-term allocation of capital within those companies. And as it turns out, the tenure of most board members is far longer than the tenure of the CEO. So the failure of a board to watch where money is being deployed, i.e. to long-run value creation versus short-term maximization of EPS, if the board's not doing that, nobody is. The second, more transactional and probably also part of the solution, is how they pay CEOs. There's not only an agency problem, there's a time-bounded agency problem in that they're very much rewarded for what happens on their watch. By definition, if you're interested in long-term wealth creation, you better pay that CEO for what that company looks like 10 years from the day he leaves.
That's what I was going to say. I'm a firm believer of what gets measured gets done. And so I do think making sure how people are rewarded is tasked to not just the short term, but the long term. And I do think the boards are uniquely positioned to ask the hard questions. You know, what's the 5-10 year outlook for the company? How are you going to get there? And it really asks those hard questions, and then understand how the company, not micromanaging the company, but understanding how the company is going to achieve that. So we were talking at the table about innovation. And, some of the best practices with innovation is having an innovation group that's separate and aside from folks with their day job, just tricks the trade like that and understanding that. So I think the board is in a really good position to ask the right question.
Anything to add, JB?
Yeah, I think it makes sense though. I mean, especially, there is the compensation piece, you can be tied to short term, but also not lose sight of the long-term piece of it. And so if someone is just going to be measured on what they're doing today, and maybe with innovation, they're not willing to take a risk to do something that's better for the future because they're going to get paid today, there has to be sort of a balance between, sure, we want you to do well today, but we're also going to look at what you've done over the 5 years and the best way that you're going to set up our company, our organization for the future success as well. Maybe it's in the share price that you get it afterwards, but I think there are certainly the board has options to look at this in a different way to incentivize people to focus on the future.
I just add to all the comments on incentives, which is an important part of the way, like we know that incentives make you look at facts differently. As crazy as that sounds. So the same set of facts with two people that have fundamentally different incentives, they interpret the facts differently, as weirdly as that sounds. But I didn't sit in on the incentive comp panels, but I read the papers, and it was really good chart that was in there how CEO and executive pay has moved a lot from what was predominantly salary to quote unquote long-term incentives. So we got some head nods back there. Yeah. So, but like you wanna, which is really good, right? And those long-term incentives are like stock options and restricted stocks. But we've also had a movement that like, you wanna double click on that, of those being performance-based. Right, so there's metrics of performance that tells you how much stock options would you get. These are like big numbers and stuff like that for CEOs, for executive team members and stuff like that. The majority of those metrics, unfortunately, have actually become short-term metrics. So it's almost like they're the same metrics as like an executive's annual bonus. And they've been pulled into EPS as kind of one of the big metrics. I would love to see just bigger thinking on that about, and I'm on the comp committee, we're pushing, with one of the companies, we're actually going this way, and we're doing kind of relative TSR, which is also a kind of a measure that, but it would be great to see that over a 10-year period, even if it vests in a shorter period. So now, this is a little bit code here for stuff, and having executives actually be forced to hold stuff right. So most of the time, these long-term kind of performance vehicles of compensation that have moved towards stock-based, they vest And sometimes executives hold it, sometimes they don't, but they're allowed to kind of like, liquidate after 3 or 4 years, which isn't long term. It's just not long term. So longer vesting periods, long holding periods, you got to figure out certain mechanics of taxes for people's individual kind of situations. And importantly, metrics that are really give people and really give executives the ability and the, almost encouragement to think really long term.
When you go around the globe, or so there's sort of other governance models, like in Germany, you have employees on boards and so on. Do you have a kind of opinion about how that would affect this debate about long-term risk or long-term thinking? Is that actually buying?
I'm against it. I wonder if we're conflating this. I'm not against it at all. And like, I think that the best companies also understand when you start to think long-term, like there's no way you can't have a long-term business with an incredibly engaged employee workforce. There's no way you can have a long-term. And by the way, this is very consistent with corporate finance theory of maximizing long-term discounted cash flow of the firm, long-term value creation. There's no way you can have that without being very utterly focused on the customer. So I think it doesn't per se solve short-term versus long-term. It's solving a different thing.
I think to that point, I mean, I definitely think there's advantages for the board and the employees or management to be there together, especially because the management's the ones rolling up their sleeves and actually doing the work. So I think it helps them understand, but I also think the board has an important role to kind of push enact a vision or establish a vision for the employees to it. So I guess I don't know of it so much to your point, Paul, that it's the short term versus long term, but I think to your point that it's a good thing to have to make sure that everybody's learning from each other. Like if I do this today, we're going to fall off a cliff and nothing's going to be good tomorrow. There's probably some information that can be shared in both directions as to why people are making decisions at the board level and whether that's good or bad for the company long term at the employee or management level.
I'll be provocative since this is a panel. I think having employees on the board is a very bad idea. Why is that? Because the very companies that Paul named are people who disrupted, they are creative destruction types. And if there's one thing European unions, United States unions don't like, it's disruption. They wouldn't like the fact that bricks and mortar bookstores get put out of business, et cetera, et cetera, et cetera. So the very premise of good capital management is the destruction of things that no longer make sense, if I can be really harsh. And that's one of the reasons that corporate leaders are not very good, because they love their jobs. They don't want that division to be shut down. The CEO doesn't have to learn something new. So the whole premise of great capital allocation for long-term value creation works against the short-term interests of most large bodies of labor, and by the way, most senior executives in corporations.
Just like a bit of a tangent, but because we started with boards a little bit, like what's the role of a board? Oversee execution, not do the execution. Think through the long-term strategy and counsel the company, manage like really tough risks that the company has, allocate capital, and make sure that the capital is done incredibly well. One of the problems with boards is in the last 10 years is we've moved to what I call a check the box board. And, effectively, we have to, public company has to kind of show every year going into the annual shareholder meeting, what are the qualifications of a board? And we've moved a little bit to, okay, we need a policy person, we need a finance, I'm the finance guy on a bunch of boards, we need a this, we need a that, we need so on and so forth. And as opposed to what's the starting point of the board. And whenever we look for board members, we recruit first and foremost of, are they going to be great people that help counsel, coach, cajole occasionally the management teams? Yeah.
Now the board is elected by investors. And so what is the role of investors to really make sure that sort of the long-term value creation is happening in corporations? They sometimes have very different goals. They have activist investors who may do that or say they do that, but they may have very short-term goals and so on. So how do you manage that part?
I think that's, to me, a lot of the tension between short-termism and a long-term view is investor return. I mean, it makes you live quarter to quarter to year. And so, that is the balance, and making sure that short-term results isn't what's driving the bus. I also think it gets to the fabric and culture of the company itself. And so when you have a culture of, we're going to reward you if you hit it out of the park, 30% return this year. And there's really not that balance on the long term. My concern is it breeds like a self-interested group versus a culture of, I'm going to do what's best for the firm, even if I'm not going to get 30%. I might get 15%, but I know in my heart of heart, I'm going to do what's best for the firm. It gets to a culture. And so I think when going back to your question, that culture within the firm has to survive the pressures that investors may be putting on that particular.
How do you do that it survives? What are the kind of things that you do?
I know. I mean, I still go back to what gets measured gets done. I still think it is a bit about, you were talking about who's on the board. Are they the right mentors? Are they the right folks to cajole people? I do think, especially in the leadership positions, that moral compass and that doing what's best for the firm over myself type mentality has to be a focus.
I think you tell the truth. I think, as I said earlier, about 75% of the market cap of the US is owned by long-term investors. And that splits, of course, into index investors and non-index investors. If you talk to the non-index, what we call intrinsic investors, the data is really, really clear. They can spot a short-term company a mile away. They can sell that stock tomorrow. And if you probe them and in statistical ways on their decision-making criteria, they're thrilled if a company is going to lower earnings to develop a new product, new business with these payouts. They recognize the world is a volatile place, and they're really suspicious when they encounter a CFO who pretends the world's not a volatile place and is playing around with accruals to smooth earnings. They see that a mile away. So if you're in that part of the world, you sell or you buy, if you will. If you're an index investor, you have a little different way of acting through institutional services, much as we often may not like them. They are a force in some of these, but even as standalone investors, large index funds have an enormous interest in long-term behavior and B, enormous leverage in doing that. So I think investors together, and it is a cultural point. I mean, part of what the board's got to do is instill courage in the CEO and the CFO to tell the truth about what they're investing in. And by the way, when something didn't work out right, be honest about that. That's what the long-term wealth creation involves, taking risks, and some of those risks won't pay off.
Bill, maybe you could fill in the blank for students of the 25%.
There are some very short-term, for sure. There are, it turns out they don't draw, I am not a capital markets quant guy, but my understanding of the analysis is those short-term traders actually have very little impact on long-term price trends in developed equity markets. But there's no question they are often the loudest people in the world of investors. And the really great investors actually are notable because they're pretty quiet.
In the old days, we used to talk about like when you're doing something incredibly important and the phone rings, you pick it up, right? So it's the most urgent thing, but not that important. And companies do get sucked into what I call the 25%, and what Bill talked about. So the financial ecosystem. So investors are made up of index funds, long-term investors, real investors that want to invest for the long term, and as well as like short-term investors. And by the way, like some of the best returns were from, Renaissance Capital, right? And like incredibly, we're doing day trading based on mathematical modeling. So it's not like nothing wrong with that. But for a company to be thinking about evolving the company over the long term, you need to be focused on kind of the 75% and not get pulled into the 25%, which is hard to do if you don't have a kind of a natural maturity and you haven't like seen that, and it's hard to do if a board is kind of saying, hey, how'd you do on EPS versus guidance for the quarter and like, and all that, you know, so there's a lot of messages that get kind of implicitly sent to focus in the short term. And what great companies do is they resist that. They just resist that and they kind of rise above it. You know, and kind of really kind of focus on it.
So there's a kind of opportunity to create what we could call patient capital, who really buys this idea from the board that you're honest and talk about that. And then there's still activist investors. So how should we deal with those?
And by the way, patient capital shouldn't be interpreted by management teams as I don't have to deliver.
Yeah.
Bingo.
Yeah, I don't have to deliver like, you know, great customer performance.
Not
Don't have
lazy
to-
capital.
It's not, yeah, and there is a little of that goes on. It's like I'm having a bad year and I'm gonna just blame it on short term or something like that. So you gotta just be mindful of that. That's right. You gotta do both. You gotta deliver business execution results and evolve the business over a long term. So that's good.
Now, in terms of like sort of reporting standards, that's the way then we talk to investors in that context. And obviously there's always this kind of talk about the tyranny of the quarterly earnings calls and so on. And then at the same time, yeah, more information is always good. We need to know about what is going on and really to understand what is happening or so. So what is your view on sort of integrated reporting that tries to complement sort of quarterly earnings reporting with more long-term measurement of things that maybe long-term value creation should care about? Is that just really complicated to do, or is it kind of useless because it's not understood? ESG could be interpreted in that way to some extent. So is there like something missing in the information to really be credible that you are having a long-term strategy?
I don't know if it's missing. I think it balances with what we've been talking about here is what, investors and people are focused on. And that's really how earnings reports are being derived. I think it comes down to, though, whatever your forecast is or your plan is and meeting that. I think if you're missing that, regardless of whether it's short term or long term, there's going to be some upset people. But I think, I don't personally have an issue with the quarterly reporting. I think it holds people accountable. And so I think it's necessary. If it went to 6 months or something, maybe that wouldn't make that much of a difference. But I think it's what your messaging is going to be more important than the frequency.
I two thoughts: capital R reporting and little r reporting. Absolutely good. I mean, screw around making it 6 months versus that would have no impact.
Yeah.
Paul's going to kick me in the shins, but if I could wave my wand on the capital R formal reporting, I would insist on far, far more granular businesses for line of business reporting, because these aggregated lines of business, they ain't businesses. They're ways to hide moving stuff around and hide whether you're investing enough in this business. So that's the big change I would make. I never got anywhere with CFO clients on that for some reason. But the little r interests me more, which is simply, and Paul's phrase, rise above this. A classic example historically has been Johnson & Johnson in an industry that I spend time in, where they don't do guidance. They don't do financial guidance. They do strategic guidance. They say, these are the 6 bets we're making on the next 10 years of this company. And they're pretty consistent in updating investors on how those long-term bets, they don't set an EPS guidance target. And I think that shift in the role of IR from being an EPS guidance reconciler to being somebody that helps the CEO and CFO talk about value creation is probably the more important reporting change I've made.
But sort of reporting on other dimensions than earnings. So what would that be, or what should they report about?
Varies by industry. I think, in where Paul spends his life, the portfolio of drug development and the behavior of new product launches is kind of 90% of the value of the enterprise. So the way a drug company reports is going to be completely different from a consumer packaged goods company. Very industry specific, I think.
Yeah, I mean, I was on the reporting panel, and moving to 6 months doesn't solve it, and probably kind of impairs kind of the issue. I think one of the best things about the United States and capitalism here is how the rules that we have, the governance where people can actually, so investors can actually feel confident. We have EY and Deloitte, like that, PwC, that like, make sure our numbers are right. And then, but that is a burden for companies. We weave it into our internal performance management of a company. So we figure out how to make it not an excessive burden. And the benefits far outweigh the costs. It pulls at though, like, just kind of go back to when you're communicating to investors, companies have to be really thoughtful of who they're communicating to and what they're communicating. When I say who, you're going to communicate like a quarterly report. The people on the other side of the phone call, on the conference call is the sell side, but you're really talking to your long-term investors. And when I teach CFOs, like how to think through about going into their earnings calls, I was like, don't think about the sell side. Don't think about the hedge fund that's worried about is your eyeballs moving to the left, catching a lie, or moving to the right. Either done over the phone, but that stuff actually, Lewis used to do that stuff, right? So like that stuff actually happens. I used to say, I am going to think about prime cap management, which is a sub-advisor to Vanguard, was the #1 shareholder for Biogen, was invested in us for 15 years. And when we talked to them, they were focused on, Paul, how's the culture of the company? How's capital allocation? How are you thinking about strategy? So you have to like go away from the natural tendency. That's like what? And make sure you're talking to the right set of investors and conveying the company.
What about earning guidance? Is that something you should do or should not do? That's a very simple question to complicate the problem. It probably depends.
I think go back, it depends on the company. Especially if you're a, I don't know, a growing technology company, earnings really isn't going to be important. They're going to focus on revenue and generating new customers and subscriptions. And so maybe that's the metric that's important to them. But I think depending on where you are in your life cycle, if you're a mature company and earnings is, well, we should be able to do something cheaper and faster. So even if I'm not growing my top line, my margin should be growing too. I think it all depends on the industry, the people looking at it. And I think even still, regardless of short-term and long-term, the important piece of it is that you're growing and evolving in some way, especially with how fast technology moves, the needs of the customer base and society does. I think that's probably the more important piece than the earnings. It's how are you evolving as a company that you're showing the people, out there.
Yeah, and I would say what resonates with me on that is a couple of comments that were made on the panel. And one is, and this might not be to the street, it might actually just be more internally, but that line of business performance metric that's not amalgamated into, that's an interesting one, because that surgical look at how a line of business is doing, to your point, it could depend on if it's, a diverse area, it might have a different metric that you're going to be looking at. The other thing is, I love what you said earlier about, you can have short-term goals, and that's fine if those short-term goals are getting you inch by inch closer to that long-term objective. And so how that factors into some of these questions, it's I think an interesting one as well.
Now okay.
We've seen a massive trend away from quarterly earnings per share guidance. So one of the papers said that it's was 70 or 80%. Now it's 20%. One of my board members years ago at Biogen asked me, "Do you give quarterly guidance?" I said to him, "No, we give annual. It becomes quarter pretty quick." So, as you march through the year, it's like 3 quarters left, then 2 quarters left, then your annual guidance is the last quarter. So people can do the math pretty easily and stuff like that. Look, I would make the point so everybody understands, even when a company decides not to give quarterly guidance, you're still going to have quarterly EPS consensus. So that quarterly EPS consensus is made up by the sell side. And when you give guidance, there's a theory around that it lowers the variability and stuff like that. I think the principle is way more about do no harm with your quarterly or annual kind of communication and what you sign up for. And so you want to make sure that your investor approach and this approach to kind of the 75% and the 25% doesn't box you into impairing the business for the long term. And I want to give you an example of a company. I'm a fanboy of Amazon, not because of everything they do, the number of trucks that come up and down my street every single day. I'm like, why can't that like be just Tuesdays and Thursdays? Like, it would be better route efficiency for them. It would be less emission and all that type of stuff. But Amazon gives the next quarter revenue and operating cash flow. So probably the most long-term company over the last 20 years actually has debunked what is this trend. And all they're trying to do is, and they don't do anything long-term, anything annual. They don't talk long-term. They focus the long-term conversation on which businesses are they getting into, all this type of stuff. And clearly they invested huge. Like IBM should have owned the cloud computing, right? IBM should have owned it. They were fixated in the early 2000s on earnings per share, which constrained their investment, which allowed Amazon to like invest 10 billion, 20 billion, 30 billion, 40 billion. And you can kind of see it in their history. But they do that because they get it. They get there's going to be numbers out there on the consensus street. They narrow those numbers in. By the way, they give themselves a nice big wide range. By the time that quarterly call happens, they only have 8 weeks left in the quarter, so they got pretty good visibility. And so they work under the principle of do no harm in your communications. And I think that is way more important for students to learn than like, oh, you gotta not do quarter. You gotta just like think about how what are the unintended consequences of whatever communication you have. Very good.
Now, in the public discourse about short-termism, so one word comes up often, and that's stock buybacks. And it's always equated as like somehow capital is like leaving the value creation process within the firm, and then their costs in terms of foregone R&D investments because of that. I think the reality is a bit more complicated. Does anyone want to comment on that?
Pretty simple. I think it's pretty simple. Can you manipulate things by buying back shares? Yeah, because you change the denominator. Yeah, but investor's an idiot. If you do the math and you're a high-performing corporation, you cannot spend all of the free cash in a, more, I'm not talking startups, but you cannot spend the free cash that's generated from a high ROIC company fast enough. You have to return money to shareholders. And most CFOs are loath to go crazy raising the permanent dividend rate. And stock buybacks are a much more flexible way to return cash to the people who want it. And by the way, the long-term investors generally prefer that they make the capital allocation decision, not you as a company, because they see more opportunities. They have a chance to make choices that you don't.
We've seen a lot of.
He may disagree with me.
The only thing I'd add is it's actually another great feature of capitalism where that money goes back to investors.
Yeah.
They put it to use in what they think are. So in a way, it gets recycled into the economy. Japan had huge restrictions on stock buybacks up until recently. I mean, and recently it's kind of been changing, and Warren Buffett's now investing in Japan. But it is not the only reason that their lost decade went to 3 lost decades, but it's a contributor to the inability for firms to effectively recycle money into other parts of a more productive economy. It's right, this recycling. Biogen does a share buyback. It goes to funding Moderna or buying or some early stage biotech that they think has a bigger opportunity to create value.
Anything to add, Jane, or?
I think that was well
Yeah,
said.
I agree. I mean, the only other thing I could add is use that capital to invest in some other company that you think is going to get a different return, especially if you're like, to your point, like how much can you invest in your own business to get the 30% margin or 50%, whatever it is. That's not always easy, but I think that's the easiest way to show results, especially if you're cash rich, which is a really good place to be.
Now we have almost exclusively talked about public companies, but there's also like private companies, and often it's said that there's less, that's going to be a consequence of, public companies are more short-term oriented, and private companies, they have the time to really develop this. So is that true?
See private companies with great deal of flexibility to look to the long term. So I'm not saying it's to the exclusion of public companies, but I do feel like private companies and, you know, large family-owned businesses, private companies of that nature, they have flexibility that the private company structure.
I agree. I think, you know, if you're a long-term private company, you're pretty much in the driver's seat for as long as you want. If you're VC backed or private equity backed, then that's a different story. And you probably face the same pressures as investors, in some ways worse. But I think if you've established yourself as a private company, then, you know, as long you sort of determine success and what, you know, a good return is.
Just thinking about generations.
Yeah.
Right. And now, by the way, that's not the big driver of our company. It's like family, but I mean, it's occasionally you'll have a colonel and stuff like that that come along. But for the most part, like that's probably not the solution we can jump to. We have to kind of, you know, solve some of these other issues.
One element of that solution, one of the reasons I think you're in the driver's seat is if you compare private equity enterprises, which is obviously a subset of privately owned, but not a trivial one, with public boards, the average annual hours spent by a board member is almost 4 times what it is in a public company. And given that these are usually much, much smaller companies, you basically have a board that is paying attention to long-term value creation on behalf of the family or private owners. And I honestly believe that until directors start spending the time required to master the complexity in a large company under the tutelage of the CFO, it's hard to be long-term oriented in a complicated company.
We have not talked about sort of the role of regulation, but for example, I've already alluded that there are very different kind of regulations around the globe in terms of stock buybacks and other things like that. So is there scope for regulations to address short-termism? Are there problems really out there that are of a kind where the corporation is not really set up to really think long-term enough, and that's a case where there needs to be some regulation?
We're seeing it in the area of sustainability, where, you know, regulations are trying to look towards what is a company doing for the long term, be more sustainable. So you can see it in pockets. So I would just say that as an example.
Yeah, I mean, I think it all depends. And if I go back almost 4 years ago at this point, like the explosion of SPACs, or special purpose acquisition companies, who were taking people public probably faster than they were expected. Eventually, the SEC came in and said, all right, maybe we have to pump the brakes on this, because there is something that is short-term for these SPAC sponsors that is a little bit different than the long-term, you know, goals of IPO investors. And so that is one recent example I can think of where someone came in and said, all right, we need to sort of figure this out and put some more regulations in there. If you still want to do it, you can, but we need to tighten it up a little bit.
I would distinguish your example from the more boring short-termism. I think you're dead right. At some levels, it'll sound like I'm really right-wing, but it's not the business of government, the performance of businesses. At the end of the day, we have the right to be wrong in our private lives, in our corporate lives. And it's not the government's job to drive company performance. It's a job to make sure there's not fraud. It's a level playing field, lots of important things. But I think if you try to legislate, you know, anti-short-term behavior, you'll come up with ideas that on average sounds good, but they're terrible in this industry and have all kinds of second-order consequences that you don't like. So I just think it's not, I mean, the issue that you put, the most important word today was the culture of this, and you can't regulate culture. It doesn't work.
I'll modestly disagree with
Good.
one.
Good.
I'm sure you and I usually align. And I agree with what you said, like the 1% tax on buybacks. By the way, like when that happened, it was like, you know, there was a little bit of exchange, it's a little bit to find exchange for the carried interest tax. So, right, so we satisfied private equity, but like made this tax. But look, the long term, this is where I think the exception, the long term existential threat is a warming climate.
That's different. I
And-
completely agree.
And like
I-
now,
I
all
completely
this, all these kind of
Agree.
these short-term things that try to solve short-term are too short terms. And they're like, kind of, and, this is business broken, had a couple episodes on this, but that's a classic, what you learn in economics as an externality that government should step in and like massively leverage what business is great at, which is going after metrics and going after numbers, right? I mean, put the regulations in place that are aggressive, that stop this, and businesses will change like overnight.
Opportunity.
Yeah, that's,
So
I would,
I think that's like
Completely
the
agree.
one which obviously we don't have this great, kind of place in Washington DC right now, but that would be if I had to wave a magic wand, solve it.
that's the one area that I immediately thought of. It's just sustainability and you can see the difference in countries where countries that focus on it there's a movement towards a more sustainable environment. In Norway and it's just amazing. So that is where I see government playing a role.
Okay, so thank you so much. I would like to turn it over now to the public because you have to listen to my horrible accent long enough. So I will now turn it over and questions. And we should probably do this with a mic. So I don't know if there's a.
What is your view on Sarbanes-Oxley and whether it was effective or not?
Get some people that.
Sarbanes-Oxley. I mean, so we have
I
a
mean,
perfect, panel. We
Yeah,
have,
I
right?
certainly can start. I mean, it was definitely in response to.
This is being recorded. You
I know, I was
So
like
you're-
that.
It's definitely in response to some very bad things that happened. Yeah. Yes. Yeah.
Just to level set, like one aspect of Enron. Arthur Anderson was their certified public accountant and was getting roughly $10 million a year of fees. Arthur Anderson was their consultant. He was getting about $90 million a year of consulting fees. So that was a bit of the impetus of Sarbanes-Oxley, which was more than that, but it really was like, hey, you can't have an auditor
Yeah.
that has non-audit related fees in any kind of excess. So go ahead.
Yeah, no, it's a fair point. And at Deloitte and EY and all the other big four, I mean, especially when you have an advisory consulting side of the house and the audit side of the house, to keep those separate, I absolutely think is an important thing. I think developing a formal set of controls that the company and the executives are responsible to follow is also important. I think they were all doing this. I mean, the idea of having someone separate from doing, preparing something and reviewing something and segregation of duties is not really all that innovative from what they had been doing in the past. I think it does formalize this and hold people accountable. I think interpretation, people might think that it's disruptive and it's gone too far and too rigid, but I think like anything, when you're introduced to something that's new, it's frustrating, it's more work, it's annoying, but then eventually I think it becomes the norm. I think if you have big established companies that have been doing this for a while, they probably don't even think about it in the extent that they were. I think it's probably more taxing to earlier stage companies or that have to do it for the first time. But then once you do something for the first time, I think it becomes normal. So I do think it's a success. I'm biased being in the accounting profession, but I mean, I do think it's a success. I think it's important. Is it perfect? No, but you know, I think it's certainly been something that's been important to the industry and investors as a whole.
I would echo that. It's funny. I remember when Sarbanes-Oxley came into play, and it was such a sea change in thinking of how we operated and how we operate now. When I think about, you know, how we used to operate, it's so contrary to today's standards. And so today's standards, I think we got it right in terms of, you know, the audit profession has to be like a bastion of principles, and then you have to have impartiality and That's good. That has to be the guiding light. So I think Sarbanes-Oxley got it right on that note. You know, the areas that, like anything, rules have a level of complexity. And so when you start to think about how the rules apply in different situations, putting a practical spin on them while maintaining that impartiality is the lever that we have to constantly push on. You know, when you get into, you think it's simple. Well, it's just, you got a company and you can either do this or you can do that. Right? But say you have a private equity company and you audit a portfolio company. What about these portfolio companies over here? Like, it starts to get very complicated when you get these up and over rules and things like that. So I think 100% we need Sarbanes-Oxley. I think the principles are exactly what we should follow. A level of practicality in some of these complex situations is always, a focus on that is always needed.
Louis, I think one of the second order consequences, we needed Sarbanes-Oxley full stop. I think a second order consequence is what Paul referred to as the check the box mindset on boards. It's not, I would have done the same thing in their shoes, but it really swung the pendulum to this. We got to make sure as a board we've complied, and it squeezes out the stuff we've been talking about, which is how does the board oversee capital allocation, value creation? Because board time's finite, and the more time you spend checking the box, less time on this. The aggravation is that there is actually, the board is not legally obligated to maximize shareholder value. They have no obligation legally to maximize shareholder value. They have legal obligations that have all to do with stewardship and those sorts of things, duty of care. And you put all that stuff together, and the strategy oversight and helping CEOs and so on work with investors, that gets nudged to the side. It's swinging back though. I think we're.
Hi, my name is Ingrid. Thank you so much for bringing this really exciting discussion. Really interesting stuff, tapped into some unknown territory for me. So my question, well, a little bit of, I guess, context. So I think what I got from out of this discussion is an important way, or some important ways to combat short-termism, is to get companies to think in a long-term mindset, to get executives to think in a long-term mindset, and to kind of communicate the long-term payback to the shareholders and stakeholders. So that's roughly what I got out of it. But I think all of this is great when we're in a stable market, both in terms of, economic core or political, orientation. So if you look at it now, I think we're at a point where, financial markets unstable, human capital markets unstable, operations unstable, all of this. So how relevant is short-termism in, this kind of landscape? Maybe is there a time when it's possibly not so bad to focus on short-termism? I think right now it's possibly, not the worst idea to try to not get your company completely messed up, right? So that's one of my questions. I have a different question that's more, I guess, more relevant to the students too. But feel free to start with this one.
Did I miss something going on this week?
Well,
So this guy wakes up every morning worried about the liquidity of his company, for example. You're dead right. Being long-term oriented doesn't mean that you're not paying attention really frequently to what's happening this minute. Absolutely. At the same time, would you want him to reduce R&D spending on a molecule that's about to go into clinical trials because of what's happening on Wall Street today?
oh, no.
I mean, there may be circumstances, but you have to be informed by what's going on today. But the hallmark of a long-term company is that it understands when to absorb the kind of things that are going on today, which of its long-term investments it ought to preserve, and which ones it ought to stop. I mean, maybe if you're about to invest in a big paper machine and add couple million tons of XYZ capacity to the market, that actually is something that I would stop maybe in given what's going on. So it's very company specific, but man, you do have to pay attention in weeks like this to what happened an hour ago.
I mean, it's a great question. It's always both. The reality is, for sure, executives, like if it was a 50-50 balance of your mind share towards execution, making sure performance is running and evolving in long term, I bet you it's on to 85, this week. So, and it probably is appropriate to kind of like, and then, but you need to like then double back right after that and make sure, are there any assumptions that came out of these crises, that we're in now, or global financial crisis or pandemic? Are there any assumptions that change your thinking about the long term? And then if not, then you move on.
Yeah, that's what I was going to say. That old adage, don't let a good crisis go to waste.
You still want
Yeah, exactly. I've seen paralysis. I've seen, okay, we're going to see what's going on and we're just going to pause until we figure out exactly how we should move forward. So I've seen a bit of paralysis, more so than a knee-jerk reaction to the day's events. And so what I'm always focused on is, if we think about the pandemic, we fundamentally changed a lot of how we operate post-pandemic. And a lot of companies who kind of looked over the horizon and capitalized on that did have a long-term view. So they took into account today's events and then applied that long-term view. I mean, I think there's a bit of a blend there. And I see that definitely in, I think there is a level of urgency that all companies should have in their near-term, long-term view on what are their companies going to look like given the pace of advancements coming at us from technology. So to me, it's digesting what's going on today and adjusting and pivoting your long-term view to account for it.
I'll close it out, but just to even think about, I think a short-term view of something like prioritization is important, especially if you're saying like, do we really want to stop, researching a specific molecule? Maybe one is not as far along as another drug. And so you could put pause, like you said, and you want to make sure that you're using your funds smart, especially if you think you're going to run out. But if you make a short-term reaction to get rid of a significant portion of your workforce, especially if this is temporary, and many times it is, and a year down the line, it's back to where it was before all this happened. Now you have to hire all new people who don't know it as well as the other, like you're going to spend more money on it. So I think that's the balance.
Tim?
So, I can see some examples, so I was trying to think about why we're talking about short-termism. And I think one thing that makes the general public sometimes cynical about business is examples of businesses that take a long-term view, but in the long term, they kind of socialize costs and privatize benefits. So let me give you two. One is the bank's mortgage origination practices in advance of the financial crisis. Another one is Purdue Pharmaceuticals marketing practices around opioids. And so I guess the question is sort of, you could take the view that, that's government's job. Externality, it's not short-term thinking, it's externalities, chase them down, put them in jail, whatever. Is there a productive thing that the business community should be doing to either kind of push back against the cynicism to say, no, we can't extrapolate to the whole business community based on these examples, even in light of the giant social costs they imposed? Or should we be changing something about governance to prevent those from happening?
I just take Purdue a little bit because that's part of the industry. It's so for people that go into biopharmaceuticals, they should required reading should be those. And that's the book that chronicled that whole thing and the opioid crisis and stuff like that. So I think to some extent, like the industry rallying around these are bad actors, it's worth it. And like, you don't want to do a lot of that stuff, point fingers and stuff like that, but that's the grotesque balance actor example. I think the financial crisis was like risk on man, right? I mean, that was probably risk on man.
It's not maybe accidental to produce a flattered number. And I'm not saying boards are always the answer, but the scrutiny, and particularly in the sector he spends his life in, scrutiny that these companies and not only their product portfolios, but their promotion practices, source of prescriptions, it's unbelievable. So it's not independent from having owners who can do what the hell they want, as opposed to publicly traded owners. But your broader point is, of course, an important one, and a troubling one. I don't know short-termism versus long-term, the more fundamental human values that we tolerate things that we shouldn't.
Yeah, I did have one offense. I guess, huge thank you for all of you for coming out, but I guess I was curious. So Bill, you had brought up the example of Johnson & Johnson and sort of strategic guidance rather than, quantifying the number. But I'm curious from maybe from like the CFO perspective, how you then deal with maybe sell side gets overzealous, consensus is too high, and you've taken away the tool to tell them, keep them in line. Does that maybe enhance volatility even more in the market if buy side's looking at that?
Probably does, and I don't think they care. I think they don't, volatility per se is not a problem if you're a long-term investor.
It's a great question. It's a very thoughtful question, and you're getting the nuances of what really happens. It means you need to secure the 50 to 75% even more, right? You can't let those conversations, that relationship drift, and double down on those conversations. The best conversations I had as a CFO, weren't when they were looking at my eyes and quite like hedge funds are trained. That is not a joke. It's the long-term conversations with Fidelity, with Wellington, with capital investors on the West Coast that talked about culture, that talked about, Paul, how do you think about capital allocation? And also, we're like, what's working, what's not? Like many people are shy away from what's not working. Most companies, and if you go with Bill's thing that report out on line of business, most companies don't have that or have that, and it's like they can see it in the financial numbers all the time. It is so important to be like, yeah, this isn't working. We gotta work on it. And by the way, they hear the garbage from companies 30 times a day. So when they hear someone say, this is working, this isn't, and they actually begin to believe it a lot.
Okay. I think I'd like to thank everyone here on the panel. It's really great to have you, and thank you for coming out, talking about short-termism, and hope to see you again. Thank you.